Welcome back, everyone. Still with me, Tamina Kaustri. Now, our next session, ladies and gentlemen, for IEEFA Energy Finance 2024 will put the spotlight on nothing else other than catalyzing private capital for the energy transition in emerging Asia. For this very insightful session, I would firstly like to introduce to you Ramnath Iyer, IEEFA's research lead for Sustainable Finance Asia, who will be moderating the discussion. He's joined on stage by panelists including Sathanbabu Mathankumar, Principal for the Tamil Nadu Shelter Fund, Asif Chima, Director for Financial Institutions Private Sector Operations Department at the Asian Development Bank, and our panel is rounded off with Luke Foley, Deputy Head of Technical Assistance at Private Infrastructure Development Group.
Hello. Morning, everybody. Welcome to this session at the first IEEFA Asia Energy Finance Conference. So I think we already had a couple of really insightful and informative sessions this morning, which kind of laid the ground really nicely for what is to follow. First of all, I am Ramnath. I am the lead analyst for Sustainable Finance for Asia at IEEFA. And what we are going to do today is, we heard about the vast investment gaps which exist. I think Dr. Ghosh was mentioning about how just the steel companies in this region would need about $300 billion to be as capex to be able to transform the steelmaking process to a greener steel. I think Chris was mentioning the investment gap that remains after taking into account all the capital that has been committed, which I think was about $1 trillion by 2040. So there are significant needs here. I think it was also mentioned in the session that private capital alone cannot do this job, that public sector, public capital needs to be part of the solution. So what we're going to do today is to try and see how private and public capital can work together to enhance investments in the entire decarbonization space. What are the various methods for it? And we are fortunate to have a really distinguished panel here with us who will explore some of these issues. So let me just very quickly give you a little introduction of all our speakers. First, nearest to me is Sathanbabu. He is an investment professional he manages the Tamil Nadu Shelter Fund, which is a unit of the Tamil Nadu state government, their impact fund management company. And before TN Infra Fund Management Company, Sathanbabu was with Piramal Capital, where he managed a real estate portfolio, and at ICRA, which is a Moody's affiliate in India, credit rating agency. He rated corporates in steel and mining, over 100 entities across the listed and unlisted space. Sathanbabu is a postgraduate from IIM Kozhikode. He's an electrical and electronics engineer and a CFA charter holder. Next to him is Asif Chima, who is the Director of Private Sector Operations at the Asian Development Bank, and he leads the ADB's support to financial institutions in Asia Pacific. He leads the Microfinance Risk Participation Program and the guarantee programs at the ADB. Before this, he was also the East Asia Urban and Social Director with experience in climate adaptation projects, especially in the urban field and in urban development. He's been with ADB for 11 years, and prior to that, he has experience with Nomura International and international banks like Bank Sarasin. He's an MBA from Yale University and a BBA from New York Institute of Technology. And last but not least, we have Luke Foley. He's been with the Private Infrastructure Development Group since 2016. He's been responsible for overseeing the technical assistance project portfolio and supporting the development of PIDG's technical assistance-related strategic initiatives. He has a breadth of experience in deploying this technical assistance and concessional capital to support infrastructure throughout the entire life cycle. Prior to PIDG, he was for 5 years at SocGen, the French bank, in private banking, where he set up and managed philanthropic ventures of ultra-high net worth individuals. He's a graduate of the University of Aberdeen, has an MA and an MSc in economics and international relations. So what we're going to do here is ask each of the panelists to make a short presentation about how they see things, what they do, and then we'll have a Q&A. In the meantime, please feel free to use the Hua app to put in whatever questions may come to your mind regarding this very important topic. So may I ask Sadan Babu first too?
Thank you, Ramnath, for the introduction. Good morning, everyone. Can you have the presentation?
Can we have the presentation up?
Till the presentation comes up, I'll briefly start about the organization I am from. I am from Tamil Nadu Infrastructure Fund Management Corporation. It is an alternative investment fund asset management company set up by Government of Tamil Nadu to focus on thematic areas which are interest for the government. We have broadly 4 thematic areas. One is increasing affordable housing. The other is green climate fund, increasing startup or supporting the startup ecosystem in the state of Tamil Nadu, and increasing infrastructure investments by bringing more private capital. The objective of the fund is to leverage private capital and to increase the private capital participation in the state, provide new models, support new models. Brief about Tamil Nadu. Tamil Nadu is one of the largest economy in the country, second largest. It has largest number of factories, most urbanized state and rapidly urbanizing, which needs more energy, more housing. There are multiple challenges, multiple problems, and with like any other emerging economy with a limited budget, public capital needs to be allocated among different areas. So to support the public capital and to increase participation of private, these thematic funds were set up. Okay. Yeah. So what we do is, I'll take an example of Tamil Nadu Shelter Fund, where the problem we had was to support affordable housing, where the gap in affordable housing was around 1 million houses because of the rapid urbanization in the state. The lower end of the lower deciles were catered to by the public the housing department. The upper end or the decile 9, 10 were catered to by the private market, which is developed, the housing market was developed. But there was a gap in the middle segments, and there was a frontier getting created where the lower end or the economically weaker section was being catered to public capital, and it was not getting observed at, say, decile 7, 8, or 5, 6. So how do we incentivize private capital was one of the problem statements. So for this, the fund was set up. The fund's objective is to de-risk the private capital by providing mezzanine debt or on any other structures which can be used to leverage more investments. In this, we had also incubated companies which focus on rental housing, where this is a new model, rental housing. Rentals in commercial space is established. There are REITs and InvITs which provide a secondary market and exits for rental housing. But in affordable housing or in family rentals or in individual rentals, there is no established market. So we have incubated these companies. We have provided equity support, technical support for this platform companies which are jointly done with private, also with public entities. In private, we provide de-risking capital. In public enterprises, we provide technology expertise. We bring in new partners to increase efficiency. So, our impact has been, we have built around 2,000 working women hostels, which increase labor force participation, female labor force participation in across 10 cities. We are also in the process of building 20,000 industrial housing beds, predominantly which will go into working women, where Tamil Nadu is one of the largest states, accounting for 40% of women working in India's factories. Similar to this, we are also coming up with a Green Climate Fund to support green infrastructure, provide a kind of a blended capital or de-risking capital, and a startup fund to increase startup. Some of the targets we focus on impact achieved, for affordable housing, we focus to increase affordable housing supply by around 5,000 affordable housing homes or 20,000 beds. In green climate, to reduce greenhouse emissions by 6 million metric ton. The focus areas on the private sector is to provide and support new developers, new technologies, and de-risk the projects. On the private public space, increase efficiency and bring in new private participation either at operating level or at the capital level. Thank you.
Thank you so much, Sadan Babu, and my apologies. I think there's been a bit of a technical glitch. So as it stands now, we have your presentation up. Do we? Do we have Asif's presentation? Or otherwise we can, I think there's enough to talk to go straight to Q&A, but if we have it, that's good.
Good morning, everyone. So it's an honor to be here and to discuss a topic that's increasingly becoming very important in global finance and sustainability efforts. As we all know, the road to net zero is not without its challenges, but with the right financial structures, we can turn these challenges into opportunities. So for today's presentation, I'll just quickly go over the overall, just the background in terms of the current state of energy transition, followed by challenges that we are facing. And then I can talk about a few case studies in terms of how at ADB and other DFIs we are tackling blended finance and what are some of the barriers that remain. So in terms of very quick background, I mean, the point here we are making is that energy transition since Paris Agreement in 2015 has been less than impressive. If we look at these numbers, while the global energy supply has not grown significantly, the energy mix has also not changed a lot, where majority of the energy is still being produced through fossil fuels. In 1967, that percentage was, in 2015, the percentage was 67% of total electricity being produced by fossil fuels. In 2023, the number has shrunk to 61%, so not by a whole lot. On the positive side, solar and wind have shown the most growth, and that's something that we can cherish and we can build on. There are positive signs, as I said. There are particularly rapid development in technologies, in solar, in wind, in battery storage. There is a lot more awareness amongst the policymakers for the need of green finance. Even corporates as well as investors are financially motivated to invest in transition activities due to the risks as well as the cost of climate change on their operations. So to meet the global goals and to ensure that the technologies which are now developed over the last 8 to 10 years, we must accelerate the implementation, and for that, transition finance is needed. So how much are we talking about? Again, there are various numbers. It's very difficult to estimate the per annum cost of transition finance. It depends on several factors, including scope of sectors involved, the level of ambition, geographic considerations, and the numbers that are provided are anywhere between 4 trillion globally to 12 trillion per annum. Now, that's a huge number. But then if you look at it in the context of where some of the other spending is going. So if you look at, for example, fossil fuel subsidies in 2022, that was more than $7 trillion. We can look at defense budgets. We can look at the overall size of what the top 24 European and US banks have committed towards sustainable finance, which is 15 trillion euros. The reality is money is available. It's a matter of driving the funds from other sources towards transition finance, which should be a priority for all of us. What are some of the key challenges for us to drive these funds towards transition finance? Lack of clear definitions, disclosure frameworks, financial instruments which are tailored for transition activities, and we are all, especially on even the multilaterals, we are working towards achieving or fixing some of these challenges by providing policy support, by capacity building, and by also providing blended finance, the right financial instruments. Sorry, I'm going through quickly with my slides because I'm sure we can have some of these questions and your questions answered after the presentations. In addition to the transition finance specific challenges, of course, the area that we are focused on in Asia or Asian Development Bank, there are very emerging Asia specific challenges also. I mean, just to give you a quick data point, 80% of green investments in high-income countries are funded by private investors. In Asia and in emerging markets, the share of private sector is only 14%. So in a region where the countries face, they have limited fiscal space and less ability to raise financing from private markets, they have the highest amount of burden in terms of financing some of these projects. And the one way to handle this is by providing blended finance solutions, which can de-risk some of the investments, provide investor comfort, and mobilize more private sector capital. So we have all discussed, or we'll be discussing today, that blended finance can play a very important role by mitigating investment risks and creating a positive impact towards net zero. What are some of the blended finance mechanisms that we have successfully used at ADB? Catalytic funds, which are basically providing more risk-tolerant capital for projects. We have provided guarantees and insurances to enhance investment security. We have provided grants as well as technical assistance to put together feasibility study for projects, as well as work with the policymakers and regulators to bring in the more feasible or investor-friendly policies for these investments. I just wanted to quickly touch upon when we are using blended finance. Of course, we are using the DFI principles to have a very disciplined approach, and so that we are not coming in and crowding out some private investors. In deploying blended finance, we ensure that our interventions address market failures, catalyze more private sector investment, and promote sustainable development. And I can talk more about some of these principles later on if there are any questions. Just to give you a couple of case studies which are important and hopefully which would allow us to replicate these success stories for providing or enhancing private sector role in transition finance. One is the energy transition mechanism. You may have heard of it, but I can talk a little bit more. This is basically to providing concessional finance for the early retirement of coal projects in Asia. Since till the end of last year, we were able to raise around $600 million of concessional finance to work on coal and for early retirement of coal projects across emerging Asia. We are not just talking about, when we are talking about transition finance, we are also working not only with large projects, we are also working with financial institutions who can then on-lend for smaller projects, even with MSMEs. So for example, last year we provided a concessional loan to Bogt Bank, which is one of the FIs in Mongolia, very, very committed towards transition activities. And basically, Bogt Bank, through ADB's support, as well as concessional finance and technical assistance, is helping MSMEs bring in energy-efficient equipment in their operations. And that helps in terms of transition activities. Finally, even on the housing side, we are working with our partners through blended finance and TA in terms of bringing in climate resilient, green, affordable housing. And we are working more closely, not just with the contractors and with the construction companies, but also with end users. So just to sum up my presentation, what are the 3 key areas for us to enhance transition finance? We need to work with the policymakers. We need to have very clear policies and guidelines in terms, especially when we look at hard-to-abate sectors such as coal, oil, and we need to put together a set of used case or case studies which would allow us to replicate those models and bring in more such projects to enhance transition finance. Thank you. We will put it up on
Good afternoon, everyone. It's great to be here with you today. I'm going to introduce you to the organization that I work for, which is the Private Infrastructure Development Group, or PIDG, or PIDG, depending on how you want to describe it. As introduced earlier, my name's Luke, and I look after the technical assistance and concessional capital offering within the group. This gives you a bit of background here. I'm going to come through these slides quite quickly so that we've got enough time to discuss some of the questions that will be presented by the audience and some of those that we have already on the panel. But this gives you an idea of where we've been for the last 2 decades. We've developed over 200 projects and brought them to financial close. In doing that, we've been able to mobilize $25 billion of private sector capital into those projects in both Asia, Southeast Asia, South Asia, as well as Africa. And most importantly, that's benefited over 200 million people with new and improved access to infrastructure. These are our goals. Last year, we launched our strategy, which will take us into 2030. And what we are trying to do is accelerate private sector capital's deployment into climate resilience and economic opportunities across Asia and Africa, with the idea that this will benefit more than 100 million people The idea here is also to ensure that that infrastructure is inclusive, that it's looking specifically at gender and inclusivity, and additionally looking at ways in which we can harness nature in order to develop some of these projects. And throughout that, it's also about reducing greenhouse emissions. We've heard today, and we've heard in previous sessions yesterday about the challenges that we currently face, which we'll get into here, about reducing greenhouse gas emissions and kind of where we are in terms of mobilizing private sector capital into those solutions. This is a snapshot of where we've gone today. So we've been provided with about $2 billion worth of ODA. And with that, we've made just over $5 billion worth of commitments, which has mobilized $40 billion worth of commitments, of which what I mentioned previously, $25 billion of that being from the private sector. This gives you an overall snapshot of what we've been able to do to date over the last 5 years. These figures are put together by Convergence. With 68 projects, we've been able to mobilize 57 of them from the donor community to provide climate-blended solutions. How we work, what is it exactly that we do? We basically take projects from inception all the way through into operation. Not every project. We obviously work on some projects at a later stage with our credit solutions, some at an earlier stage with the development arm that we have, as well as with the technical assistance offering we can work throughout the project or the infrastructure lifecycle. This gives you an idea of the sectors that we work in. Good for our discussion today. The majority of our portfolio and our pipeline is in energy, looking again at both on and off-grid solutions, as well as how we make cities more resilient to climate, as we live in a day and age now where we cannot avoid the challenges that climate change presents. And additionally, we're also invested and actively looking at transport and logistics as well as connectivity in the region. Water and natural resource management we'll touch on a little bit in some of the examples that I will give later. This gives you a flavor of the types of projects that we have in our portfolio as well as those that we're looking to develop in our pipeline. I've mentioned TA. TA is obviously my wheelhouse. This is one of the things that we can do. We can seed funds to provide first loss capital. We can also put technical assistance to use in order to implement gender initiatives. We've done that in Cambodia on a cold storage facility. And additionally, we can provide concessional capital. Generally, this looks in the form of viability gap funding or concessional debt. But likewise, we can provide it on the equity side. And we've done that in Vietnam on rural water supply. We can also provide early stage equity and development capital through our project development arm. We've done that in Vietnam with Vietnam's first utility scale solar project, which was 100% financed with foreign capital. Additionally, water again makes an appearance here in our portfolio in Cambodia. This is again providing initial access or first time access to water in Cambodia. And then also looking at industrials and commercials. How do we green the activities of those commercial entities? We've been able to do that in Nepal with rooftop solar. And then finally, credit solutions. We're going to talk a little bit here about foreign or hard currency lending versus local currency lending and the importance that both of them play. With Garanco, who you may be aware of, we are able to mobilize local currency lending into infrastructure projects. Similarly, with the Emerging Asia and Africa Infrastructure Fund, we are also able to provide long-term hard currency lending. And then finally, with the credit enhancement facilities that we have, which are effectively replications of Garanco, they're able to provide local currency solutions to local parties. We've been able to do that firstly in Asia through InfraZaman, who have had a number of transactions go through already, so I would certainly point you in the direction of InfraZaman's website to learn a little bit more about their offering and the successes that they've had. And that's it. Look forward to our discussion.
Thanks, Luke. So maybe we should just, in the interest of time, dive right into the Q&A. And let me start off with a question actually for all of you. In terms of, we talk a lot about why private capital or capital in general is moving slowly, and often a word used, especially in some of the more developing countries, is the enabling environment isn't there, that the policies are not necessarily in place to to actually make use of that capital, that the projects are not ready to make use of the capital. How much do you think that is a problem, and what can be done from a project perspective to be able to solve it? And can blended finance actually influence and try and change the enabling environment? Maybe I just start with maybe Luke, and then we move downward.
Yeah, can you hear me? Yeah, that's good. Yes, the enabling environment is important, and blended finance can provide part of that solution. What I think is critical is that the enabling environment does not just relate to the private sector, it also relates to the public sector. How do they want to bring projects to market? We've heard, it's been said for a long time, that there's a lot of capital which is sitting on the sidelines. It's not for the lack of capital, it's for the lack of well-designed projects. And I think that is something which we are now beginning to see change. There's a lot more correspondence between the private and the public sector as to what it is that they require in order to get comfortable with deals. I think what's important for the public sector when it comes to the enabling environment is consistency. Private capital will see inconsistency in the way in which regulations are in place or put in place as more risky. Therefore, they will either remove themselves from that market or they will charge more for it than they potentially should because of a perception of risk. Therefore, blended finance can provide solutions on a deal-by-deal basis, but it's not about getting one deal done, it's not about getting 2 deals done, it's about getting 10 deals done. Therefore, on the upstream side or the enabling environment side, there needs to be very clear regulations and practices which are put in place, and understanding of what it is that the private sector requires in terms of security in order to make these investments, because these investments are long-term investments. You're looking at 15, 20 years of investment. They need to be sure that if they're going to start out, whether they're a developer initiating a project which could take 2, 3, 5 years to get to financial close, that they are going to be spending their money and their time appropriately. And similarly with lenders, whether local currency lenders or international lenders, they need to ensure that if they are going to invest in a project which could have a 15, 20-year life cycle, that they are still going to be able to have their debt paid in year 15, not just year 1 and 2.
Great. Asif, from your vantage point?
Thank you. No, but I fully agree. I think the first policy environment is extremely important. So if you look at Asia, green finance has grown over the last year by 40 to 50% in this market, which is a tremendous growth. Now, for example, China is the largest issuer of green finance in the world. They raised $175 billion last year. The other 2 markets which have done really well in this area are Japan and India. And they both, Japan raised around $20 to $25 billion, India another 15. So but this growth has not been uniform across Asia. There are countries which have yet to raise any green finance. And one of the key difference really is the policy environment. In China, for example, PBOC has really pushed and mandated the banks to do green financing. They have very clear taxonomies. There are free zones for green investments, so hence it has attracted international capital. Similarly, in Japan, there are tax incentives, there are incentives for investors, and hence there is an investment towards transition activities. In India, with National Solar Mission, that saw a huge amount of investments going on the solar side. So the policy environment is critical, and that can attract and drive investments towards transition finance. And then, of course, financial structuring, which includes blended finance. What are the key risks in a project, and how they could be addressed, either through providing in longer tenor patient capital from concessional finance providers, or by providing some sort of guarantees to make investors more comfortable. And I agree there needs to be some sustainability and comfort towards sustainability of the policies so that international investors are able to make these judgments. So, yeah, thank you.
So Asif and Luke covered more on the policy and on blended finance helping. I'd like to add that in projects, new projects or new technologies, there is inherent volatility in cash flows, or there is no established cash flows for some years. So this is increases the risk or multiplies the risk. But over a period of time, this stabilizes, and that might lead to the entities getting traditional financing. So what is required from a blended finance perspective also is to support these entities at an initial term to share the risk, participate in the risk, or kind of providing a de-risking environment where the private capital invests equity and towards middle of the life cycle can tap in traditional resources, banking or financial institution resources. Apart from this, public entities also, if they provide a long-term patient capital, which sees some of the de-risk some of this. So slide has come up.
No, I asked him to put that up now that it's ready for one particular thing, and I want to ask you about it.
So here we had a case study.
Right.
The next.
About how your
how we de-risked a particular investment. If you can go to the next 2-3 slides. The pointer. So this is a funding model where we utilized public capital to de-risk a private project where we provided $20 million USD of public capital and leveraged it with other project lenders to increase it to 120 million project size. This for a long-term industrial housing project where 14,000 beds are getting created for an electronics manufacturing company. This is mostly a private driven where we take participation in the board to ensure that our equity is secured. Apart from that, this is a model where the industry purchases the land. There is a private contractor to design and do it. The industry again provides a committed offtake. We provide a mezzanine debt, which is utilized by the industry to leverage it to another 4 times and provide this. Provide a long-term solution for industrial housing where the yields are typically low compared to commercial rates, where the development yields are expected more than 10% or 9% in Indian context. Here the yields start lower, but with the inflation and over a period of time, this is expected to increase, and we will be there till this is getting replaced by a bank loan, or we are getting an exit through distributed units through rates. This is another example where we formed a public entity, and here the private sector is expected to come at a later stage to de-risk the public entity or to participate in the public entity. Till then, the designing and operating is done by the public entities. I'll just run through the case studies. This is the first project which we are talking, where we had 50% of the project is ready for operations, and this is our working women hostel across Tamil Nadu. We had done it. These are the facilities which have been provided, and it is around 99% occupied. Some of the challenges, which I'll briefly touch, is lessons learned. We have to participate in the risk, tenure and structuring, which Luke and Asif touched upon. What didn't work, we started with the stricter conditions, and then we had to adapt to the market. Some of the yields challenges, this is also for green transition, lower yields in the and viability gap funding. Either we provide a longer tenor or provide a grant to solve this This is what the impact of two funds which we are in the middle of creating. Thank you.
Great. So maybe let me ask a question for Asif and Luke. How do you evaluate FX risk in a lot of these projects where the revenue streams are essentially domestic, they are local currency, while the project cost may not necessarily be FX, but then the lending is often FX and the lenders do not want to take the local currency risk. How do you, as a blended finance or intermediary here, account for that? And what can be done to minimize that risk?
Thanks, and absolutely, that's a very critical risk that we need to mitigate. So, for example, most of the MDBs, and if you look at ADB, on the private sector side, wherever we can, where we have the ability, we provide financing in local currency. Majority of our financing now in for example, markets like India, where we have the ability to go to local capital markets and we can raise local currency financing. That's what we do, and provide on the projects. Our financing is in local currency, in line with what the needs of the project are. Of course, there are FX hedging solutions that are available also. If local currency is not available, we can work with institutions like TCX, which provide local currency hedging solutions. We also work with local banks who can then provide some sort of hedging or provide local currency to even to project sponsors. But yes, this is something that we really need to mitigate for projects, to de-risk projects and investors to get comfortable with.
Yeah, I think it's important to look at it from the perspective of, say, a project sponsor, a project developer, and what they are looking for when they're looking for a financing package. You're right that if there are revenues which are being generated in local currency, as Asif has mentioned, if you do take out foreign currency lending, there will need to be some form of hedging, which will be at a cost, which needs to be factored in on top of the margin that lender may seek to put on the cost of their debt. However, foreign currency lending also offers things that at times local currency lending does not. There may be markets where the local currency or the capital market is not deep enough, is not willing to provide long enough tenors, or could be more expensive than foreign currency lending. What I think is important to remember is that while we want to find local currency solutions, there can be times when it is more appropriate to have a more open market to debt, and therefore to encourage international lenders to come in. That is a way to tap into the resources of private sector capital, which are on the sidelines. But at the same time, it is important to help mobilize local currency financing, and some of that can be done through local regulations as well, allowing pension funds or insurance companies to invest in infrastructure. But it's not an either or. It's not that one is good and one is bad. It's just that they will offer different solutions to a project sponsor.
Great. So I've been wanting to ask you, Asif, about MDBs, as to what can MDBs do more, or what can MDBs do to sort of speed up the energy transition and to have more of the private investments, catalyze more of the investments. And I think there's also some questions on that, specifically with ADB having so many years of data on their projects and essentially actuarial data. Why isn't more of the capital being used in the form of like guarantees or contingent capital, essentially? Maybe you want to talk about it. It's something that's come up many times, I think.
Thanks. So I think in terms of MDBs and also for ADB, I mean, we can play a role, and we have been playing a very important role in transition finance across wherever it's needed, right? So when we talked about policy side, so we have done a lot of work in our member countries to ensure that there is the right policy and regulatory framework which would drive capital, which would incentivize investments in transition finance, which would also make international investors more comfortable. So that work is being done through our sovereign sector by providing policy loans to various governments. We have done the other role, an important role that MDBs can play is on the technical assistance and capacity building side. The next step, of course, when the right policy environment is there to put together or build a pipeline of projects that support transition activities. And that requires capacity both on the regulatory side, but also on the private sector side. And it also requires feasibility studies, for example, for these projects, and that's the work that we have been doing. And finally, then we come to financing. Wherever there is a need, so if there is a need for the guarantees, then of course the MDBs can play a role. We have been providing guarantees in the past. There are a number of projects, but yes, this needs to grow to catalyze and mobilize more private sector funding. But then there is also direct financing that multilaterals have been providing. And more, there are more innovative financing structures like the blended finance. I talked about energy transition mechanism, which ADB is supporting. We have also put together another fund called Private Sector Asia Infrastructure Fund, LEAP, which has mobilized through providing blended finance more than $2 billion of private sector investments in Asian infrastructure projects over the last 1 year alone. So, I mean, we are going across policy, capacity building, technical assistance, as well as in providing financing, both in the form of direct financing and guarantees. Thank you.
So the other question is, and there are some related questions, I'll try and sort of blend it into one, which is that when you look at some of these projects, and essentially the role is to be catalytic capital, how do you determine which project has the potential to be a catalyst that can then draw in more private sector investments? What is the, can you give us some examples, or how do you actually measure that? And the related question, which is from the audience, is for technologies such as CCS and nuclear, which have, let's say, limited success stories and have showed to have prominent impact on the environment. I mean, we do not have enough examples of that. How do we determine whether it's worth to invest in such projects? So basically, it's more specific, but yeah, in general, how do you determine what can be catalytic? I don't know, who wants to take that? Luke, maybe?
Yeah, I can start off on that. I think just to take a step back in terms of when we assess whether we should deploy our capital onto a project, we look at a few things. One is its impact on people. As I mentioned in my presentation, it's important, and I think it is necessary for us to mobilize private sector capital because it is required if we are to meet the goals that we have set ourselves. But it's also about the impact that has for individuals on their day-to-day lives and their ability to access infrastructure. So we will look at people, we will also look at climate, and we will also look at economic mobilization, economic development that the project itself will have, and then also whether it can be replicated. Is this the project that we should pursue? Is this the project that not only we should provide more commercial tranches, but more blended or more concessional tranches of capital to? And again, what you want to look at there is what is it that is causing this project to be borderline? What is it that the private sector is looking at in this project and seeing as a risk? Is it pricing, and what's driving that pricing? If there's a more fundamental issue with the project, which is potentially stopping that project and subsequent projects coming to the market, say it's a policy level issue, then it will be very difficult for me to make the argument to my committee that by doing this project, it will open up more opportunities for more private sector investment into the market. So understanding and having that ongoing dialogue with private sector investors, both those who are invested into the funds that we have, as well as those in the market, to understand what it is that is causing them to either stay in the sidelines or to price their debt, their equity at a certain rate, that's an important part for us to understand. This is why we should pursue this. You touched on some sectors which are more nascent, and I think that is where blended capital should also be deployed. If you go back 20 years, solar and wind were more nascent sectors, particularly in the markets, in emerging markets. The technology itself is understood now, it's understood by the private sector. There are other challenges which may be presented to the private sector to invest in certain markets, but in those, such as carbon capture, where there's an opportunity for us to try new things, try new technologies to address greenhouse gas emissions, I think that's important. Similarly, on green hydrogen. That's another area where I think that there is an opportunity for us to use blended finance to begin to establish a track record of how that technology and other technologies can be used.
Can I just follow up on that? So here we have, let's say you have a choice of deploying your capital either to a new technology which may or may not work, like you mentioned, some of these, versus deploying it in a technology that works, but not enough capital has been available in a certain geography. Let's say. So we have two different dimensions here. One is a technology, the other is a geography. The capital is limited. How do you distinguish between the two, and how do you, take a decision on those? And what do you think is the right way to go about it? I mean, there is no one right way, but yeah.
So I think in terms of looking at either or, we wouldn't normally do that. We wouldn't say, oh, we're going to just look at new technologies and that's where we're going to deploy our capital. Again, we need to understand, does the underlying project make sense? Are we mobilizing private sector capital alongside us? That would be part of our raison d'etre. So if there is no private sector capital alongside us, it's not to say that we can't go in with MDBs or DFIs, but it's important for us to bring private capital with us. And then it has to, or we have to make the decision as to, is the balance, the right balance of public, blended, and private capital in order to pursue that project. And it's also, I mentioned those different variables. If you look at climate, people, and economy, it's important for us to understand what are we seeking to achieve with this project. There may be projects that we pursue that are going to provide more people with first-time access to infrastructure. And therefore, we will look at potentially providing blended solutions to that project because it has a direct impact on people, versus some projects that we may look at where there's a direct offtake from an offtaker, and there maybe this is about driving scale, new technology. So again, it's not an either or for us. It's more about where do we think that our capital is going to have the most impact on people, as well as mobilizing private sector capital.
So how do you sort of, from your perspective, how do you approach these things in terms of deciding which project is catalytic and which is not, and how do you go about that?
So when we look for a catalytic projects which can be replicated, what methodologies we look at is one, heuristically, what is the rate of return, and compared to a similar project in a traditional area, what is the difference, and whether a blended finance will provide that provide for the incremental risk, and how long does it take to pay back compared to other traditional ways. For areas with new technology or new business model, we start with a small pilot project to test the waters and look at whether it can be replicated. With the initial success, we tried for another round of funding in the same platform company, which we are pretty much doing now. We're looking for second round of projects. So I'd say that how to differentiate the risk or divide the risk into two categories. One is traditional project risks and the new technology or new area risk, whether that can be mitigated or that can be provided for by a bundle finance or a concessional capital.
Great, thanks. So there's another question specifically on ADB, Asif, and that is about what is the biggest challenge for MDBs like ADB in mobilizing resources, and how do we scale overall volume, and are we able to meet the demand fully? I guess right now we are not, but do you think we'll be able to is probably a better question, and how?
I think the overall challenge is same that is for all of us, right? So to ensure that we are moving towards net zero in as fast and as efficiently before it's too late. Is the financing there? As I shared in my presentation, absolutely. The funds are available. The technology is available. I think that the challenge really is for us to move fast and to be able to structure projects, to build projects, put together the right financial structuring and to actually have a very cohesive global policy, global support for this work. So I think the biggest challenge that we face, for example, in Asia is harmonization of various taxonomies, various policies that would allow, once it's done, international investors to be able to invest in the projects with more confidence. The other challenge remains capacity on the policymaker side as well as on the project sponsor side, and that work needs to be done, and which we have been currently working on. But really, like I said earlier, it's more of an opportunity we should look at than a challenge. There are a lot of positive signs. We have seen what's happened in, for example, solar, in wind. I mean, those technologies are now even, in many cases, cheaper than fossil fuel technologies, and hence we have seen a lot of growth there. We can see this work and these technologies in other hard-to-abate sectors also deployed there, and we can support it to achieve our targets.
Now, going back to the risk, I mean, one side is, of course, the catalyzing the capital. The other side is the risk. Can you, talk about any particular specific mechanisms or ways to sort of, slice the risk and de-risk some projects? I mean, we keep talking about de-risking projects. Maybe with some example as to how exactly, how can we de-risk certain projects to make it more attractive to private capital? Is it just a first loss kind of a mechanism, or what are the variations that are possible? What are the improvements that are possible on that? Any of you?
Yeah, I can start on that. I think it depends on at what stage of the project you're in. I think if we let's take a risk for developers, which is obviously origination risk. There is a need then for capacity building TA to help move projects through the early stages of approval. So again, I mentioned at the very beginning the need to have consistency in policy and regulations. And therefore, what a project sponsor does not want to happen is to get caught in limbo. They don't know what agency, what ministry is going to approve this, when they are going to approve it, because obviously time is money when it comes to finance. On the origination side, I think that one of the ways to combat that risk is not just to look at what the likes of MDBs could do, or institutions like myself in terms of being able to provide that upstream capacity, but everyone in that or at that stage has agency. The public sector also has agency in terms of being able to put very clear guidelines, to make it very clear who is making or who is taking the approval, and providing those entities with the power to do so. I think once you move into the financing side, there are ways in which blended capital can be used to address potential issues of off-taker risk with guarantees, as well as risks that the private sector may price in, which are, again, more perceived rather than real risk. They obviously have their own regulations, particularly I'm speaking about international lenders here. They may have regulations which mean that they have to price their debt in such a way. Therefore, guarantees, first loss, can be a solution there. It's not always the solution. It doesn't always solve that problem. But there are ways in which you can begin to understand what is the best way to address this specific risk at this specific time. But I just want to point to the fact that it's not that one party has the solution or that one party is the one who's responsible for doing this. to get private sector off of the sidelines, we do need the private sector to begin to look at these projects. We do need MDBs to take a role. We do need DFIs to take a role. We also need the public sector to take a role. Everyone has to be part of the solution in order for it to be delivered in a very tight timeline that we have set ourselves.
Great. Is there anything anyone wants to add to that?
I would like to add, in slicing the risks, the difference I see in a new green or any other similar sector is one, the technology risk and offtake risk, which needs policy interventions, policy support for the technology to be taken or offtake, committed offtake. The other is it requires a longer gestation period where it can be accounted for by providing a long-term patient capital where MDBs, DFIs, or some kind of sovereign support or guarantees required. And one more area is the counterparty. The counterparty is new because some of these technologies also have new counterparties who invest and would like to incubate the project and work on it, but they might need lack institutional capacities, so some kind of active involvement in the management is also required, or a technical assistance from the likes of the multinational and development banks or development finance institutions will be required.
Okay, I think there are quite a few more questions, but I think in the interest of time, I think we're running out of time. So I think this has been most useful. I mean, there were a few glitches to start with, but I think we managed to answer most of the questions that the audience had in mind. And it was certainly very useful for me to learn about how you go about slicing the risks, how exactly do you try and select a project for catalyzing the capital, and I think hopefully it was also extremely useful for all of you guys. So please join me in giving a hand to our panelists here. Thank you very much.